2 weeks ago, I had dinner with a Fortune 500 CEO. I won't tell you which company, but you've heard of them. They employ 150,000 people across America. We were discussing his 2026 planning, and he said something that made my blood run cold. Ray, we're preparing for layoffs, not small ones, massive ones. 20 to 25% of our workforce. We haven't announced it yet. The board doesn't even know the full scope. But the numbers don't lie. Q1 2026 is going to be a bloodbath. This wasn't panic. This was cold calculation from someone looking at real data, real orders, real consumer behavior. And they're terrified. Right now, the financial media is telling you the economy is fine. The stock market is near all-time highs. The Fed says we've achieved a soft landing. Politicians are celebrating job creation. But underneath the surface, every single recession indicator I've studied for 50 years is flashing red. Consumer confidence just crashed to 88.7. The second worst reading since April. The unemployment rate hit 4.4%, the highest since October 2021. 69% of Americans expect unemployment to rise further. The Conference Board's leading economic index triggered its official recession warning signal in August. And corporate profit warnings are surging to levels we haven't seen since 2023. I've been here before. In 2007, I'm sitting in my office at Bridgewater watching these exact same patterns form. I told clients, a recession is coming. Reduce exposure, build cash, prepare for the worst. They looked at me like I'd lost my mind. The market was at all-time highs. Housing was booming. Everyone said I was crazy. Then 2008 hit. The clients who listened preserved their wealth. The ones who didn't lost 40–50% and spent a decade recovering. Now here we are again. Different bubble, same warning signs, same inevitable outcome. Except this time, the debt is 10x larger. The imbalances are more extreme, and the tools to fight recession are exhausted. I'm going to walk you through exactly what I'm seeing. First, the hard data that proves recession is inevitable. Second, why this recession will be worse than 2008 in critical ways. Third, the 3 scenarios for how this plays out. And finally, how to protect yourself before it's too late. Because I promise you, when this recession hits, and it will hit, most people will be completely unprepared. Their jobs will disappear, their portfolios will crater, and they'll ask the same question people asked in 2008. How did we not see this coming? The answer is simple. You weren't looking at the right data. But I am, and it's screaming. Let me show you exactly what I'm seeing in the data, because this isn't opinion, this isn't doom-mongering, this is cold, hard mathematics pointing to one inevitable conclusion. The Conference Board's leading economic index triggered its official recession signal in August 2025. This isn't some minor technical indicator. This is the most respected recession predictor in economics, and it uses the 3 Ds rule to signal impending recession. Here's what triggered it. The 6-month diffusion index fell below 50, meaning more components are declining than rising. And the LEI's 6-month growth rate plunged below -4.1%. When both criteria hit simultaneously, a recession is likely imminent or underway. The LEI's components tell a devastating story. Manufacturing new orders are collapsing. Consumer expectations are cratering. The labor market is deteriorating with rising unemployment claims and declining hours worked. The only things holding the index up, stock prices and credit conditions. And those are lagging indicators that always look good until they don't. Justina Zabinska-Lamonica, senior manager at the conference board, put it bluntly. Overall, the LEI suggests that economic activity will continue to slow. A major driver of this slowdown has been higher tariffs, which already trimmed growth in H1 2025 and will continue to be a drag on GDP growth in the second half of this year and in H1 2026. Translation: recession is coming. The only question is timing. Consumer confidence plummeted to 88.7 in November, down from 91.4 in October. This is the second worst reading since April, and it's accelerating downward. But the headline number doesn't tell the full story. Look at what consumers actually believe. 69% expect unemployment to increase over the next 12 months. Only 27.6% say jobs are plentiful, down from over 30% earlier this year. Labor market expectations are decidedly negative, according to the conference board. And it's not just sentiment, it's behavior. 85% of Americans are worried about money, the same percentage who worry about their health. 46% are losing sleep over financial stress. 57% don't feel financially secure. 82% are stressed about debt. When people are this scared, they stop spending. And when consumers stop spending, which represents 70% of U.S. GDP, the economy contracts. It's not complicated. The unemployment rate hit 4.4% in September 2025, the highest level since October 2021. That might not sound dramatic, but here's what matters: the direction and the speed. Unemployment rose from 4.1% in June to 4.4% in September. That's a 0.3 percentage point increase in 3 months. The number of unemployed surged by 219,000 to 7.6 million. Unemployment claims are rising. Average weekly hours in manufacturing are declining. This is exactly how every recession starts. Not with a sudden spike, but with a steady, accelerating deterioration that catches everyone off guard. And here's the really scary part. Analysts expect unemployment to hit 4.5% by end of Q4 2025, and potentially 4.5 to 4.7% through 2026. When unemployment rises that fast, it doesn't stop at 4.7%. It overshoots to 6, 7% or higher because layoffs feed on themselves. One company lay off workers. Those workers cut spending. Other companies see revenue decline. They lay off workers. The cycle accelerates. Here's what's happening in boardrooms that the public doesn't see yet. Corporate profit warnings are surging. UK-listed companies issued 64 profit warnings in Q3 2025, up from 59 in Q2. That's the highest level in almost 2 years for some sectors. But the content of these warnings is more revealing than the quantity. 19% cited weaker consumer confidence, up from just 6% a year ago. Among retailers, over half referenced falling consumer sentiment. Construction warnings nearly tripled compared to 2024 levels. Media and advertising sectors hit a 2-year high in warnings. And it's not just UK companies. U.S. corporate guidance for 2026 is turning cautious despite strong Q2 2025 results.
Companies are generating profits now, but management commentary reveals sustainability appears increasingly worrisome. The combination of consumer pullback, trade policy uncertainty, and sector-specific pressures points to a potentially challenging environment ahead.
CEOs see what's coming. They're preparing for the worst while publicly staying optimistic. And when CEOs start quietly planning massive layoffs, like that Fortune 500 executive told me, recession isn't a risk, it's inevitable. Let's talk about what the statistical models are saying. The Cleveland Fed's nowcast model estimates a 24% probability that the U.S. was already in recession in October 2025. That's not trivial. The Treasury yield spread model shows elevated recession risk. The SAM rule and its variants are approaching trigger levels. The SOS indicator isn't signaling yet, but it's climbing. Here's what I've learned in 50 years. By the time these models hit 50% probability, you're already in recession. The models are backward-looking. They confirm what already happened. If you wait for statistical certainty, you've waited too long. Every recession is unique, but this one has characteristics that make it particularly dangerous. Let me explain why 2026 could be worse than 2008 in critical ways. In 2008, U.S. national debt was $10 trillion. Today, it's $38 trillion and growing $69,000 per second. That's not just a bigger number. It's a qualitative difference in policy flexibility. In 2008-2009, the government could run massive deficits to stimulate the economy. We went from $10 trillion to $14 trillion in debt. Painful, but manageable. Today, if we tried the same stimulus as a percentage of GDP, we'd add $5 to $7 trillion in debt. That would push us toward $45 trillion. At that level, debt service costs consume 20–25% of the entire federal budget. We're trapped. We can't stimulate our way out like we did in 2008. The debt burden is too large. Interest costs are too high. We've already used that tool. In 2008, the Fed cut rates from 5.25% to near zero. That 5+ percentage points of cuts provided massive stimulus. Today, rates are around 4.5 to 5%. We have maybe 4 percentage points of cutting room before we hit zero. And here's the problem. If recession hits and inflation is still running 3–4%, the Fed faces an impossible choice. Cut rates to fight recession and inflation accelerates. Keep rates high to fight inflation and recession deepens into depression. In 2008, inflation wasn't a concern. They could cut freely. Today, they're constrained. And that makes this recession much harder to fight. In 2008, consumers had some capacity to tap home equity and credit. Today, consumers are already maxed out. 85% are worried about money. 82% are stressed about debt. 57% don't feel financially secure. When recession hits and unemployment rises, these consumers can't smooth consumption by borrowing. They're already leveraged. They'll cut spending hard and fast. That accelerates the downturn. The Conference Board explicitly cited tariffs as a major driver of this slowdown that will continue to be a drag on GDP growth in the second half of this year and in H1 2026. Tariffs act like a tax increase and supply shock simultaneously. They raise costs for businesses, force price increases for consumers, and reduce real income. In a strong economy, that's painful. In a recession, it's devastating. We're heading into recession with tariffs acting as an accelerant. That didn't happen in 2008.
It makes this downturn more severe and harder to escape. Let me outline the 3 scenarios for how this plays out, and I'll tell you which one I think is most likely. Scenario 1. Soft recession, 20% probability. In this scenario, the Fed cuts rates aggressively starting Q1 2026. Unemployment rises to 5.5%, but stabilizes. GDP contracts for 2-3 quarters, but doesn't collapse. Corporate earnings fall 15-20%. The stock market drops 20-25% from peak. Housing softens but doesn't crash.
This is the optimistic scenario. It requires the Fed to cut rates fast enough to arrest the decline without reigniting inflation. It requires consumers to maintain some spending despite fear. It requires no major external shocks, no geopolitical crisis, no financial system stress, no corporate debt defaults. Possible? Yes. Probable? No. I put the odds at 20%. Scenario 2. Hard recession, 60% probability. This is the most likely scenario. Unemployment rises to 6-7%. GDP contracts for 4-6 quarters. Corporate earnings fall 30-40%. The stock market drops 35-45% from peak. Housing prices fall 15-20% in most markets. The Fed cuts rates to near zero, but it's not enough because the problems are structural, not just cyclical. Consumers are over-leveraged and can't spend. Businesses facing falling demand lay off workers aggressively. The tariffs remain in place, acting as a continuous drag. This looks a lot like 2008-2009. Painful, long, but ultimately recoverable over 3 to 5 years. I put the odds at 60%. Scenario 3. Debt crisis depression, 20% probability. This is the nightmare scenario. The recession triggers a sovereign debt crisis. Treasury auctions start failing as foreign demand collapses. The Fed is forced to restart QE on a massive scale, 300 to 500 billion monthly. This reignites inflation even as unemployment soars. We get stagflation, rising unemployment and rising prices simultaneously. The dollar loses significant reserve status. Capital flees to hard assets. The stock market drops 50-60%. Housing crashes 30-40%. Unemployment hits 9-10%. This is worse than 2008. This is 1930s level economic dislocation. Social and political upheaval follows. I put the odds at 20%. Not likely, but not impossible. And the consequences are so severe that even a 20% probability demands preparation. So what do you do? Here's exactly how I'm positioning and advising clients. First, build cash reserves. Minimum 12-18 months of expenses. I know that sounds extreme, but when recession hits and unemployment rises, you want the flexibility to weather the storm without forced selling. Second, reduce debt aggressively. Pay down high-interest credit cards and variable-rate loans. Lock in fixed rates where possible. Debt is death in a recession because income falls but debt payments don't. Third, own defensive stocks if you're staying in equities. Consumer staples, utilities, healthcare. Companies with pricing power, stable demand, and strong balance sheets. Avoid anything cyclical, anything with high debt, anything dependent on consumer discretionary spending. Fourth, own hard assets as insurance, gold, commodities, productive real estate. In the soft or hard recession scenarios, these hold value. In the debt crisis scenario, they surge. Fifth, preserve employment optionality. Make yourself indispensable at work. Build skills that are recession-proof. Network aggressively. Have a backup plan if layoffs come. Sixth, watch the leading indicators. Initial unemployment claims, consumer confidence, corporate earnings guidance, credit spreads. These will tell you how fast things are deteriorating. Right now, you still have time. The recession hasn't fully hit yet, but the window is closing. By Q2 2026, it will be obvious, and by then, it's too late to position. I called the 2008 recession when everyone said the economy was fine. I positioned Bridgewater to not only survive, but thrive while others lost fortunes. I'm calling it again now. The 2026 recession is inevitable. The data is unambiguous. Consumer confidence is collapsing. Unemployment is rising. The LEI triggered its official recession warning. Corporate profit warnings are surging. And the structural imbalances, massive debt, exhausted policy tools, over-leveraged consumers, tariff headwinds make this recession particularly dangerous. That Fortune 500 CEO preparing for 25% workforce cuts, they're not wrong. They're just early. By mid-2026, every major corporation will be making similar decisions. The question isn't whether recession is coming. The question is whether you'll be prepared when it arrives. I was right in 2007-2008. The clients who listened preserved and grew wealth while others were devastated. I'm right again now. And the clients who prepare will survive what's coming. The wave is building. I can see it in every data point, every indicator, every conversation with CEOs and policymakers. And when it crashes, probably Q1 to Q2 2026, most people will be caught completely off guard. Don't be one of them. The recession is inevitable, but your response isn't. Study the data. Build cash, reduce debt, own defensive assets, and prepare for the most challenging economic environment since 2008. Because I promise you, when this hits, the only thing that will matter is whether you saw it coming.